There are all sorts of risks when it comes to investing, but most of the time when somebody asks me about managing risks in their investments, they're really talking about volatility. They're wanting to prevent significant declines in their portfolio. Hi, I'm Chris Alman, and I work with small business owners and entrepreneurs to take the uncertainty out of exiting their business and retiring comfortably. So, how do you limit the chances of seeing a significant decline in your portfolio? Well, if that's something that you're wondering about too,
stick around.
if you're like most small business owners, you probably don't have a lot of experience investing in the markets. And if we're honest, it's because you can't get the kind of returns that you see from your business anywhere else. And not to mention, you feel like you have more control over things.
Keep telling yourself that, darling.
But in the stock market, it feels like you have no control. So let's take a look at what you can do to reduce your risk of seeing a significant decline in your portfolio. So first off, when most people talk about investing in the market, they're talking about the S&P 500. And while the S&P 500 is a large and very well-known market, it's just one of many. So instead of me listing out every one of them, we'll break them down into categories called asset classes. So in the US, you have large cap, mid cap, and small cap. You have developed international markets. You've got emerging markets. Then you have bonds, and there are corporate bonds, there's government bonds, there's municipal bonds. Then you have commodities, you've got real estate, and all sorts of different types of alternative investments. You might be wondering why all of this is important. So let me ask you a question. If you only had one customer for your business, what would that mean for your success?
You're my number one customer.
What would happen if that customer decided one day that they were unhappy with the results, or they found a better price somewhere else and they decided to leave? Well, I can tell you it's not going to look good.
It's not good. It doesn't look good.
And the same is true for your portfolio. If you only have one investment in your portfolio, then it's at a significant risk of seeing a decline if something happens to that one investment. That company could go bankrupt, or that market could collapse because of some new technological innovation. Whatever it may be, there's a tremendous amount of risk there in just owning one investment. So the first step is to diversify. And you may not want to own every single different type of investment or asset class that I've mentioned, but you want to consider what's going to fit well in your portfolio based on your values and the goals that you have. So some of these investments come with higher risks, but they're also typically paired with higher returns.
No pain, no gain?
So you really have to decide, what's going to be best for you. So the second step to reducing the risks in your portfolio is just to realize that you can't control the markets and you're going to experience downturns. And instead of trying to figure out, what to buy at the right time, you have to focus on the fact that time in the market always beats trying to time the market. So prepare for those downturns, know that they're going to come, and instead of focusing on that day-to-day news and the information that you hear constantly through the media, focus on having a long-term perspective, just like you would in your business. I bet you didn't start your business with the thought that you were going to start, see a little bit of growth, and then sell. No, you started your business knowing that there's going to be some rough patches, especially in the early years. You're going to see some great growth. You're also going to have some setbacks along the way. Remember that the stock markets are full of thousands of other companies just like yours. And their goal, their mission for their company is to serve their clients and their customers, to improve their lives while making money at the same time. And sometimes they have to borrow money. Sometimes they have customers that get upset. Whatever it may be, they're going to have those setbacks just like you do. But at the end of the day, you know that your business is going to do well, and they expect the same thing. So quit looking at the day-to-day stuff. It's only going to cause stress. In fact, there was some great research done by Richard Thaler, Amos Tversky, Daniel Kahneman, and Alan Schwartz around myopia or nearsightedness and loss aversion. And what they concluded was that investors that had more frequent feedback on their investments, in other words, they were watching it all the time, they tended to have more poor results. So they weren't taking as much risk in their portfolio because they were feeling that stress, that anxiety, because they were looking at it more frequently. So take your focus off of the short term, place it on the long term, because if you focus on the short term things, it's only gonna lead to
Heartache, nothing but a heartache.
So although there's no magic pill and there's no special remedy to completely eliminate the chance of having a downturn in the market, if you'll remember that diversifying your portfolio and focusing on the long term and just remembering that time in the market always outperforms trying to time the market, you're going to have success. So with that,
Do you have any other questions for me?
so as always, feel free to reach out. I'd love to hear your story, love to chat with you and just understand what you have going on and help take the uncertainty out of exiting your business and retiring comfortably. If you liked today's video, please hit that subscribe button and I look forward to seeing you soon.